All right, welcome back. We are jumping straight into part 4 of our 8-part series on William J. O'Neill's legendary CAN-SLIM system. Today, we are tackling the letter N. And let me tell you, this one is a game changer. It goes against one of the biggest instincts most investors have. So let me ask you a question. Just look at this. You've got two choices. The stock that's gotten crushed, feels cheap, like it's on sale, or the one that's hitting a brand new all-time high. Now be honest. Which one does your gut tell you to buy? Probably the cheap one, right? Feels safer. But what if I told you that in the world of true superstocks, that feeling is almost always wrong? And it's not just you. William O'Neill himself called this out. He said people just love the feeling of buying something that's down. It feels like you're getting a deal, Like you're finding this amazing secret in the bargain bin that nobody else has seen. But that comfort, it's a trap. And it keeps people out of the real market winners.
In fact, O'Neill gave this a name. He called it the great paradox of the stock market. The very stocks that look the most dangerous, the most expensive, the ones breaking out to new highs, are often the ones that are about to absolutely explode higher. And the letter N in CAN-SLIM, that's the key that unlocks this whole paradox.
So what does this N actually stand for? Well, it's not just one thing. Think of it as a collection of powerful catalysts, signals that a company is about to hit the accelerator. Let's break down exactly what we're looking for.
The N really covers 4 key ideas. We're looking for newer companies, game-changing new products or services, fresh new management, and, this is the big one, stocks hitting new highs. Each one of these can be like pouring rocket fuel on a stock price. Let's dig into each one.
Okay, first up, newer companies. Now hold on, this does not mean you should run out and buy every single brand new IPO. That is not the idea. We're looking for young, innovative companies that are really starting to find their footing. So why younger companies? Well, think of it like this. They're in their prime. They usually hit their fastest growth spurt a few years after going public. They're still nimble, They're like a speedboat that can zip around and change direction, while the old corporate giants are like massive cruise ships that take ages to turn. They can innovate without getting bogged down in bureaucracy.
And that speedboat idea leads us perfectly into our second catalyst, new products and services. This right here is the engine of almost every great success story. And we're not talking about a minor update. We are talking about truly revolutionary stuff.
Like O'Neill said, huge success comes from things that are dramatically new. Things that literally change how we live or work. I mean, think about the biggest winning stocks of the last 20 years. Pretty much every single one of them had a product that created a whole new market out of thin air.
Our third catalyst is new management. You'd be surprised how often a change right at the top can completely change a company's fortunes. It's like a sports team bringing in a new head coach. A new CEO can bring in a new playbook, a fresh perspective, and just light a fire under a company that was going nowhere.
And that brings us to the final and most powerful catalyst, the one that feels so wrong but is so right. New highs. This is it. This is how we solve the great paradox. The whole idea here is to buy a stock as it's breaking out to a new 52-week high. And I know what you're thinking. Buy it when it's at its most expensive? Yes, and here's why.
The magic concept here is called overhead supply. Let's paint a quick picture. Imagine a stock drops from $40 down to $30. Okay, now think about every single person who bought it above $30. They're all losing money. And what are they all praying for? Please just get back to what I paid for it so I can sell and get my money back. The second it does, bam, they sell. This creates a huge wall of selling pressure. But a stock hitting a brand new high, it has no overhead supply. There's no wall. Everyone who owns it is making money. It has clear blue sky ahead of it, an open runway to just take off.
Now, theory is one thing, but let's see how this plays out in the real world. And honestly, there is no better poster child for the N factor in action than Apple back in the mid-2000s.
So let's follow the story. First, Apple drops the iPod on the world. Talk about a new product, right? It completely reinvented an industry. Then the stock price starts building a beautiful classic chart pattern. And then on February 27, 2004, it blasts off to a new high. Do you see it? It was the perfect storm. The new product was there, the new high was there, all the N factors were firing on all cylinders. So what do you think happened next?
A gain of 1,580%.
That's the kind of explosive move that's possible when you combine a revolutionary new product with the pure power of a new high breakout, completely free from all that overhead supply. That is the N principle in its purest form.
All right, you've seen the theory, you've seen the proof in a real monster stock. Let's do a super quick quiz just to make sure these ideas really sink in.
First question, what is the great paradox? It's that idea that feels totally backwards, right? It's that the stocks that look the most expensive, the ones hitting new highs, are often a much, much better buy than the stocks that look cheap because they've been beaten down.
Okay, next question. What is overhead supply? That's that wall of sellers, remember? All those people who bought at a higher price and are just desperate to get their money back. A stock at a new high has zero of that resistance. It's got that open runway we talked about.
And last one, this is a bit of a softball. A revolutionary new product is a huge catalyst for which letter in the CAN-SLIM system? Of course, it's the star of today's show, the letter N.
So as we wrap this up, let's just make sure the big idea is crystal clear. The letter N isn't about just blindly chasing stocks that are going up. It's about learning to spot the specific fundamental and technical clues that a company is shifting into a new gear of incredible growth.
So here is the bottom line. New is the fuel. New companies, new products, and new price highs are the signals. They tell you that a company is separating itself from the pack, and our job as investors is to learn how to spot these signals right as that monumental run is getting started.
So we've covered C, A, and now N, but we've still got S, L, I, and M to go. To make sure you get the rest of this breakdown of what is one of the most statistically backed approaches to the market out there, do yourself a favor and hit that subscribe button right now.
So, are you ready for the next letter? We're diving into S for supply and demand in our very next explainer. This is where we learn how to see the footprints of the big money institutions. You can click the link right up there on your screen to go straight to part 5. Come on, let's go. I'll see you there.